Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/rive to receive the top 10 stocks to buy right now. Axon reported earnings after the market closed on Tuesday, and there was a lot to like about this report. But the stock's actually cratering down about 15% as I'm recording on Wednesday. So, what is going on here? What are investors looking at? What should we be looking for from an operational standpoint? That's what I'm going to dig into today. My name is Travis Hoyam. Thanks for watching Rive Investing. Please subscribe here on YouTube for all my content. And let's jump into these results. I want to start with what I always look at first from Axon. So this is a breakdown of the company's segments. Axon Cloud is the cloud services, so the recurring revenue that it's getting from storing data on the cloud and offering other services to law enforcement agencies. In the most recent quarter, $116 million in revenue. That's just incredible given the fact that this was a business that didn't even exist a decade ago. That was up 51% from a year ago and 2.6% quarter over quarter. Keep that in mind because I think this quarter over quarter number is going to be really important as we go through these results. Sensors, that's actually the body cameras themselves. $92.3 million, up 42% from a year ago, but only 7.5% quarter over quarter. Gross margins, this is exactly what you expect to see. Gross margins are going to be much better on the software side of things than they are on hardware, but Axon does make a nice profit on selling its hardware. The Taser business, which continues to be a huge and probably underappreciated business for Axon, $134.3 million in revenue, up 17.4% from a year ago, and gross margin 62.2%. So just a great business there if that's all it was. But obviously you add in the body cameras and the software services. That's what makes Axon so powerful. And this is really the segment that I wanted to look at because I think this is what investors are a little bit disappointed in at the end of the day. Annual recurring revenue, $520 million. That's up sharply from $348 million a year ago. Net retention rate, 121%. It's one of those SaaS metrics that tells us how much they're growing with the customers that are currently on board. But this is the one that I think is catching a lot of people off guard. Total future contracted revenue, 4.8 million, only up slightly from 4.65 million just a quarter ago. And Taser devices not being sold on a recurring payment plan like they were a quarter ago. So some changes there in the growth rate and especially the future contracts. This is the outlook and the increased outlook a little bit. Now expecting about 22% growth for the year and expecting adjusted EBITDA margin to be about 20%. So that's a solid increase. Axon has really started to transition to being a profitable company as opposed to just a growth company that was then plowing all of the money that it made into sales and marketing and R&D and growth. Now we're starting to see those profits kind of pick up, but maybe not picking up quite at the pace that a lot of investors hoped. This is the other thing I wanted to touch on is the income statement. And this is where you can see, especially where operating expenses are trending. And this is where things are a little bit concerning if you're looking for Axon to become a little bit more profitable. $187.5 million in operating expenses. That's mostly selling, general and administrative, but increasingly a lot of spending in R&D. That's up from about 139 million a year ago. And that's the reason that we see income from operations actually dropping slightly from a year ago. So despite all the growth that we talked about, income from operations are actually coming down. Net income is coming down because of the fact the company is investing more in its operating expenses. So Axon is growing in tasers, it's growing in body cameras, it's growing in the cloud. Margins are improving, it's become very profitable. It actually has a pretty solid balance sheet with a net cash balance. So why is the stock dropping? It's simply because the stock is so expensive. Shares trade for about 14 times sales, and net income is actually on the decline. And the company isn't, frankly, making a lot of net income to begin with. So with a $16.7 billion market cap, even after the drop in shares today, this is still a very expensive stock. Now, all of that said, I think this is a very good company. It's a valuable company. It's growing. It's increasing margins. It's increasing the gross profit that it's making over time. It's just a balance of what do you pay for a company that's still investing a lot in the growth of the business through those operating expenses. I think that's what investors are really debating, because the one thing is if you're investing a lot in those operating expenses, you want to see backlog grow. And that's the thing that didn't grow a lot this quarter. So I think it was a great quarter, but I've actually sold some shares in Axon recently after holding them for many, many years because the stock was simply getting too expensive. I think that's exactly the reason that we're getting the response we're getting today. What would you think of the results and the market's reaction? Leave those comments in the comment section below. Don't forget to follow Rive Investing. Thanks for watching, everybody. See you here next time.